Good morning. Welcome to day 2 of our Momentum Investments Virtual Think Tank 22. I want to thank all of you again for making the effort to dial into our conference, and also for those of you who did so yesterday. On 7 and 8 September, we hosted more than 100 people at the Stationers Hall in the City of London for our 21st annual Momentum Global Investments Think Tank. We're delighted to be able to share this event also virtually with you today, with so many more of our clients and partners based in the United Kingdom, South Africa, and in all our other offshore markets that we operate in across Asia, the Middle East, and Latin America. But before we get started, just a few housekeeping points to remember. The platform provides the ability to ask questions during each of the presentations and sessions, and members of my team, and in most cases the speakers themselves, will be on hand to chat and to answer your questions in that way. For SA viewers, please add your ID number, and for our UK participants, please add your advisor firm's FCA number to the CPD section to earn the relevant points that will be allocated. There's no need to do anything else, as the system automatically verifies the time that you spent with us. Just a reminder also that the virtual platform will remain open until the end of October. If you would like to view any of the presentations that you weren't able to see today or would like to watch again. South Africa and UK delegates will also be able to still earn CPD points during that time. After October, all of the videos will be available on our events pages and in the Global Matters portal on the momentum.co.za website, as well as the Global Matters WhatsApp bot and our MGM website, momentum.co.uk. I do hope that you enjoy the different presentations and sessions this morning.
Nothing illustrates the disparity of wealth and circumstance in the UK than the distressing sight of homelessness on the streets. Whilst tragic in itself, it's perhaps only the tip of the iceberg, as homelessness encompasses other hidden victims, which include families in overcrowded, poor quality, yet often expensive temporary accommodation at the expense of local authorities. We've invested in Home REIT, managed by Gareth Jones and the team at Alvarium, who act as investment advisors to the Trust. At IPO 2 years ago, the REIT was not only offering reasonable return for investors, but crucially for us, this was achieved by increasing the stock of housing supply for the most vulnerable in our society. I can't think of a more socially responsible win-win for investors and society alike. I therefore have pleasure introducing to you Gareth Jones.
So today I'd like to just try and give you an overview of what we've achieved thus far. Well, basically, first of all, who we are, what we do, what we are trying to achieve, trying to address a problem in the market, bringing in private capital to help alleviate a social problem, whilst obviously still keeping an eye on a return for investors, capital growth and things like that. Who we are, first of all, is a Home REIT PLC. We IPO'd in October 2020. We had an initial public offering that achieved a £240 million raise. We've done 2 subsequent raises, the first one in September last year of 350 million, and one at the end of May this year of 263 million. So as it says there, we've totaled 853 million. In terms of equity capital, we've added on another 250 million of debt. And with that, we're still in a deployment phase. We've currently provided over nearly 10,500 beds across over 2,000 properties, helping alleviate homelessness or those who are at risk of being homeless across a variety of local authorities. The structure that we use is a long lease model. All of our leases are index linked, subject to a collar and a cap, which I can get into later. And the fact is that we have the lowest rents in the market, which means there's a strong residual value and alternative use in a downside scenario. We've built up our network now over the last 7 years, which was accelerated through legislation changes. So that means that all of our investments are off market, and we do also deliver uplift at the type of purchase. Next slide just takes you through who we are as a fund manager. Alvarium Home REIT Advisors are the people who, the organisation that manages the trust. As you can see there, that I'm Gareth Jones, accountant by trade. I've been in the sector now for nearly 10 years. My co-manager is Charlotte Fletcher, a lawyer by trade, and below us we have a variety of transaction lawyers, asset managers, and other accountants who help us with our analysis and going forward. So a very robust team. We're also part of the wider Alvarium team that has now 20 billion of assets under advisory, with 11 billion in real estate. And also looks after other PLCs that you might have heard of, such as LXI. This next slide just takes a step back, really, and just wants to highlight the challenge of homelessness in the UK. When we came to IPO in October 2020, it was estimated that 300,000 people were at risk of being homeless or homeless. The actual people on the street are probably only taking up 5 to 10% of the overall problem within the UK. With COVID, with removing of the safety nets, such as the Everyone In initiative, that is now estimated to be above 500,000 people. The reasons for homelessness can be wide in variety, but it really stems down to two things. It can be a loss of income and financial difficulties for people who might have already been, I suppose, okay and on the ladder, surviving within the UK, but then something hits, financial difficulties, lose their home, spiral into probably getting all the way down into the streets, or it's from leaving institutional atmospheres. It could be leaving prison, it could be leaving the armed forces, the foster care system, slipping through the cracks, not having a fixed home to go to. And then again, once you don't have a fixed address in the UK, it's very difficult to get back on your feet. You can't usually get a bank account, you can't get a job, it's very hard to get benefits. And that's where people are slipping through the cracks. The impact of that is obviously huge. The biggest stat, I think, that on this slide is the fact that those who become homeless are 10 times more likely to die than those of a similar age. And that is an overarching stat that always sticks in my mind. On the rest of this slide goes over different financial impacts for the UK, but the one on a human level that really hits home is that fact: you're 10 times more likely to die at a similar age if you are homeless. All the other stats on here just show how the amount of money that the UK government is currently spending on trying to alleviate homelessness. Just to pick out 1.1 billion annual local authority expenditure, housing homeless people in temporary accommodation. Temporary accommodation really doesn't solve the problem. It probably just delays the inevitable that someone will cycle out and go back to square one. And again, just picking out another stat, 18 billion is the cost of reoffending in the UK economy, with 67% of people released from prison without a home reoffend within a year. The overarching thing here is a house is a first step to really solving a problem. Everything else from that point becomes far easier. Again, this slide probably has a lot of detail on it. I'll try and pick out the pertinent points. What we offer is a tailored, cost-effective housing supply for those in need. We buy properties either off the tertiary market that need to be converted or refurbed, that we can then lease to charities or housing associations that will provide those properties to those in need. I'll get to it on another slide. Funding has been unlocked within the UK with legislation that was passed in 2018, which means that the homelessness cohort is supported in terms of funding directly from central government. All of the assets that we buy stand up on a bricks and mortar basis. They have strong residual value, which means that if they were, which we don't design them to be, but if they were used in other markets such as PRS or student market, the investor is insulated from drop in value because they are good bricks and mortar assets. But primarily, what they do for the underlying occupants is provide a good quality living space. It gives them a base to build on. We have wraparound care from our tenants that allows people to have pastoral care. It might address low-level drug and alcohol problems. It might address mental health issues. But from that point, once those things are alleviated, then it builds up their confidence. It would be things like helping with CVs, helping with financial management, helping interview skills, get a job, helping social skills. And giving them a toolbox to basically, once they leave our accommodation, which could be anything between sort of 18 months to 5 years, we hope that they will never return to homelessness. They get back on the ladder, they go back onto the system, they can take their own tenancies, and things like that. They move forward and be a contributor to the economy and society. Where we buy our properties from is a wide-ranging source of properties. What we normally do is we source our properties, we then find a tenant that is appropriate for that area, and we work with the local authority to make sure we're addressing a need within that local authority, so that we underpin the deal from the very start. We make sure we've got appropriate properties, we make sure that there's a local authority need, and we make sure that we pick the tenant partners can address that need. There is a huge benefit to our tenants, number one, to help them grow, to help them address this problem in a long-term nature, but also there's a huge benefit to the local authorities. Due to the Homelessness Reduction Act of 2017 that came into force in 2018, it meant that local authorities are under a legal duty to house those who are homeless or at risk of being homeless. It placed a huge burden on local authorities. It also put a burden on all public services to refer those who are homeless or at risk of being homeless, and really swelled the amount of people that needed to be housed. The local authority was then faced with a huge problem. The only alternative they really had was a short-term accommodation, local B&Bs and hotels that, as you can see from the table at the bottom, were far more expensive than the solution that we are providing. And also it was only a temporary accommodation. They would be put in there, and then suddenly if the hotel or the B&B had a higher rent rate that they could get, they would throw someone out, and then the local authority was back to square one. A person might go back to a hostel, or heaven forbid, they go back onto the streets. What we do is we provide stock on a long-term basis, really giving that security of tenure for our tenants, which means that they can help rehabilitate multiple people through the 25-year lease. But the key is what we do is set our rents at the lowest rate in the market. Every local authority within the UK sets a local housing allowance level. That's usually the lowest rate in the market, and that is what we pin all of our rents at. That is a discipline that we always stick to, and it really is the bedrock of what our fund is. What it means then is that our tenants are paying the lowest rent in the market. It means that it's a sustainable level of rent, and it means that they have a good buffer between what they pay us and the benefits they can claim on behalf of the person that is being housed. It means that it gives them financial stability, and it means that it's a long-term relationship. That long-term lease also, as I said, gives them that security of tenure, which is so important. What we've seen prior to the legislation and prior to, I suppose, the structure that we have is that charities and housing associations would build up a stock of beds where they were actually helping the problem within the local authorities, but the underlying freeholder wasn't tied into a long-term lease. It could be 1 or 2 years. They might build up to 500 or 1,000 beds, and then suddenly at the end of that lease, the underlying freeholder goes, actually, my property's worth, we've had underlying residential property going up by 10% or 8% or whatever, and actually I'm just going to sell the freehold. It's going to go into PRS and student, and that charity that worked so hard to build up their housing stock is suddenly back to ground zero. So it's something that we've worked on over time. We're probably the first to do it, and we're very proud of what we've achieved. This takes a step back and kind of and gives you an overview of what the legislation meant and what the legislation allows us to structure these deals and, I suppose, make maximum impact. What it shows here is that typically government funding for our underlying tenants within this sector represents 100% for the cost of care and housing. These are the most vulnerable people in society, and the legislation unlocks that it comes from the exempt housing benefit pool. What that means is the housing benefits flows from the central government, from the Department of Work and Pensions, through to the local authority, and then through to the charity tenant in the terms of housing benefit. Out of that housing benefit, they pay a portion of that to Home REIT, and that's typically around 40 to 50% of the housing benefit claim. It allows them to build up buffers for such as things as maintenance, the wraparound care, and operating their operations. As it says here, all rents are pre-agreed with the local authorities. We make sure all of our rents are at the lowest level in the market, the local housing allowance levels. And we also, which is very important at times of high inflation that we are at the moment, we've put a cap and collar within our leases, meaning that they are sustainable over that 25-year period. We have a cap of 4%, and there's no catch-up in terms of that. We will only raise our rents by 4% per year, even when CPI falls back. It will only raise at what CPI is, rather than catching up for 4 times of high inflation. As I am an accountant, I've put some financial stats in here of what we have achieved thus far. We're very proud on the social impact side, which we'll go through later, but we've also been able to deliver returns to investors. Since IPO in October 2020, we've taken our NAV from 98p up to 111.2p. That's a 13.5% increase in NAV, and in that time we distributed 3.9p of divvies to take us to a 17% return in those 18 months. That's ahead of where we thought we would be at IPO, the reasons being we've bought probably better yields than we thought we were going to buy, and we were able to secure long-term debt at better rates than we had modelled. That's obviously been very pleasing, and it's also enabled us to get support from the investment community, from people like yourselves at Momentum, and been able to grow the capital pot, as we said, through 3 different raises over quite a short space of time. In terms of social impact, what we've achieved is we've now bought over 2,000 properties. We're providing over 10,000 beds and helping address homelessness and those who are at risk of being homeless in 126 different local authorities. We have 28 different tenant partners who are delivering a saving to local authorities of over 60% when compared to that alternative type of accommodation that really isn't addressing the problem. People do become homeless for, as I said, for a wide range of issues, and it just shows, I suppose, the wide ranges of things we are addressing within those 126 local authorities. And our focus is on the social side, but we do also look to address the green side as much as possible. We have 100% green leases within our properties, and also we will only buy properties that are close to local amenities and transport so that they have a low carbon footprint. This slide just sort of highlights that the sort of rigor that we have within the social impact that we are making. We've had an independent audit of our social credentials by the Good Economy Partnership that was released in September last year. It will be updated. With our annual report this year. And I suppose the biggest thing and the biggest comment that we are highlighting on this is 2 things. We provide good value for money, good quality properties. It provides excellent value for both the tenant partners and the taxpayer. But also that quote at the bottom, we're helping to improve the lives of homelessness or those at risk of homeless. Findings to date suggest that residents are very satisfied with the quality of the accommodation and support that housing partners are giving. It's helpful and valued. I mean, that is really what we tried to do from the outset. Pairing the private capital that we get to alleviate a social problem. The next few slides, and I'm sure the guys will be able to circulate this presentation for you, and you'll be able to go through the quality of the properties that we're buying, but also the stories that the underlying occupants have. It could be, as I said, people who are trying to address low-level drug and alcohol problems, and then that has spiraled into other difficulties. It's those fleeing domestic abuse, or those, and this one was leaving prison without a home to go to, and how getting back on their own 2 feet. And then also another one that we do is those fleeing domestic abuse. As I said, hopefully they'll be able to distribute this, and you can read that in more detail. There's appendices that give more detail about what we do, our non-exec board, our financials, if anyone's too excited about that. But I suppose the last thing I want to address is the fact of where do we go next. We've grown the trust now to over $1 billion of assets, but that we're only really scratching the surface of the problem. As I said, it's probably over 500,000 people who will be at risk of being homeless, or at risk of being homeless at this very moment, and we're providing 10,500 beds. We've been very responsible from the very outset to only raise capital to a distinct pipeline, so there's no surprises for investors. We've had very little cash drag. We've been able to invest our equity within 4 to 5 months of every raise that we've done, and we're well on our way to achieving that or better with our latest raise, and that's what we'll continue to do. We had an ambition to get to $1 billion of NAV within 3 years. We're well ahead of that at the moment, and we will continue to look to grow in a responsible way, as long as the legislative structure is still there, as long as the properties are still available, and as long as homelessness still is a problem.
So we're going to take a slightly different route with our next presentation. Our next speaker is Paul Nixon, Head of Behavioral Finance at Momentum. Human behavior impacts every aspect of our lives, but probably no more less important than in financial decisions. Therefore, it's really pivotal that advisors first of all, understand clients' emotions when making financial decisions, but also are then able to adapt how they approach particular clients. And we'll have all seen that, certainly in COVID, certainly in the recent financial crises that we're seeing. So, here to tell us more, ladies and gents, Paul Nixon.
Just walking around here during lunchtime as well, the amount of times that I hear during lockdown and COVID, COVID is still very much a part of our lives, right? And we've all got COVID stories to tell. I mean, I think even though we're looking at COVID now through the rearview mirror, I think we're all happy, or at least happier, to be getting alcohol these days in the right end, right, which is in our mouths as opposed to kind of, mostly on our hands, right? But I think, because we've all got COVID stories, I thought I would start today's session with one of my own COVID stories. So my wife and I are certified coffee snobs, right? So hands up, coffee snobs out there, right? I see a few. Hey, there we go. Phil, Steve, I'm sure you are one as well. Has anyone been to a coffee tasting before? Like, not a wine tasting, a coffee tasting. Okay, so here we go. So if you see someone aggressively slurping coffee with a spoon, right, you're at a coffee tasting. And the reason why they do that is because, as you're slurping the coffee, you're introducing air, right, into the liquid, which releases a little bit of the flavor. So the coffee culture in South Africa is evolving. It's catching up with the rest of the world. And in actual fact, anyone heard of geisha coffee? People are willing to pay more and more for coffee, just like they are willing to pay more and more for wine. So geisha coffee, you can expect to pay anywhere between $8 and $80 for a cup of coffee, right? And the reason is that the geisha coffee tree is, it takes about 8 years to bear its fruit. So coffee lovers would know, the more time it takes to bear fruit, the more flavor gets sucked up into that bean, right? So my coffee story is my wife and I decided to open a specialty coffee store in Benoni on the East Rand of Johannesburg. And we did so about 3 weeks before national lockdown. Right? Of course, we didn't make the decision to do it then. Of course, we'd signed the lease 6 months before. But we ended up being in hospitality in the middle of national lockdown. Right now, I can tell you for free what that feels like. It feels like you're on the Titanic. So remember the movie? Remember when the ship is sinking and the band just decides to take out the instruments and carry on playing? We were the band. There is nothing you can do but you watch your world unfold around you. Now, I'm going to circle back to this at the end, but in essence, there's 3 key messages that I want to get across today. The first one is emotional biases cause a behavior tax. Right? It doesn't matter if you're in the coffee business, if you're trading stocks, or if you're giving investment advice. The second one is that investment advice is much more than just about numbers. Right? It's an excellent opportunity to engage people, connect with people, and help them process their financial struggles that they're having, which is worth something. And the last thing is that perspective matters, right? Perspective matters, and it matters a lot. And that's where I'm going to start off on today's presentation, because perspective is very key to understanding the disposition effect. Okay, so nice way to show this. If we're going to understand the disposition effect, we need to understand something about context. Okay, so Dogbert consultants have a wonderful way of looking at this. Very cynical, of course, but that's what makes it fun. So in the left there, Dogbert is basically saying to the manager, your fake 50% sales price makes dumb customers feel like smart shoppers. Now, the reason for this is that marketers and retailers have known for a very, very long time that they need to get us from the spend frame to the save frame, right? We don't like parting with our money, right? We're naturally loss averse. But by buying something 2 for 1 or 50% off, we're actually saving money, right? Because now we're getting 100% off, right? So if we feel better about something, in other words, when we go to the save frame, we feel better about it and we feel smart about it as well, right? Because we found something. And that's what economists will call a transaction utility. Now in the middle frame, the manager is saying, well, why am I paying you $400 an hour to tell me what I already know? And of course, Dogbert finishes off this conversation by saying, well, usually I charge $800 per hour, right? And of course, the manager leaves that engagement, yes, I'm a freaking genius, right? So feeling very, very smart. And of course, you know, the manager has fallen prey to the very same tactics that he uses on his customers. Now, if you doubt the power of this, I'd like to take you back to 2011. So JCPenney, largest discount retailer in the US. Everyone's heard of JCPenney, right? And JCPenney decided to headhunt a chap by the name of Ron Johnson from Apple. Now, Ron Johnson's claim to fame was he rolled out about 400 of their Apple Experience stores in the US. And one of the first things that Ron Johnson did was his first strategic decision was to change their pricing policy, right? So in a very famous media interview, he got up and he said that people will come to our stores because they're great places to hang out, right? That sounds very Apple. I'm not sure if that sounds JCPenney, but they'll come to our stores because they're great places to hang out and people would be happy to pay an everyday low price for everything. So what happened in this situation is, what happens when you take away the transaction utility that people get when they find stuff that's good value or cheap? They just go somewhere else, right? And that goes down, you'll see it in the MBA case studies, is like one of the most epic strategic fails by a company or by a CEO, costing JCPenney billions of dollars, right? So don't underestimate the power of what's demonstrated very clearly in this Dogbert cartoon, right? So perspective definitely matters. All right, so let's get a bit more practical. Let's see how retailers use this. So what you can see on the screens now are 2 deals for a cup of coffee, right? Still on the coffee theme. One of them clearly sucks, okay? And it shouldn't take you very long to figure out that it's the one on the right. Okay, so the one on the right looks like a bad deal. $2 versus $8. The question is, how do we get people to buy the bad deal? And the way we do that is we add in another option, right? So we add in an option in the middle, and what we do by doing this is we change the perception of what the bad deal is, right? So the option in the middle now is $7, and all of a sudden the deal on the right looks like the good one. Right, so again, this is about changing perspective, changing perception. And what obviously is happening here is our attention is drawn to the middle and to the right option. Okay, and this is a tactic that's very, very famous and well utilized and is called the decoy effect. Okay, but I mean, that's a cartoon. Let's have a look at something. We talked about Apple. Let's have a look at something from Apple's website. So here are actual deals for Apple MacBook Pros. And let's quickly just work through them. I'm not sure if you can see that right at the back. So right at the left, we'll see that there is a deal for a 2 gigahertz processor, 256 gigabytes of storage for $1,499. Okay. By the way, some nice psychological pricing there, because we know that $1,499 is way less than $1,500, right? In the middle, we go to a new feature, right? So now we've got the Touch Bar and Touch ID, a 2.9 gigahertz processor, and 256 gigabytes of storage once again. Okay, $1,799. And on the far right, Touch Bar and Touch ID again, 2.9 gigahertz processor again, 512 gigabytes of storage, okay, for $1,999. So who's going to be brave and shout out, which one is the decoy? The middle one, lady in the front, I heard that there, right? So the middle one is obviously the decoy, right? So if we take it out, we can see that if we don't have the middle one, these are kind of difficult to compare. So whatever you buy is probably going to depend on your preferences, right? You either need a faster processor or you want like storage for your photos and your song and music. But the minute we add the middle option in, our attention is drawn to those two simply because they're quite similar. They've both got Touch Bar, Touch ID, both got 2.9 gigahertz processor, but now we're getting double the amount of storage for $200. Okay, so we're drawn to the right option. The middle option is the decoy, right? And by the way, when you finish this stuff as well, they've measured people under fMRIs. You feel very smart when you pick the right one, like very smart. Huh? So there's like parts of your brain that lights up. Again, it's a transaction utility. So you feel good about the system because you figured it out, right? But of course, that's not really the way things work. So marketers have known that in order to get you to buy stuff, they can work and fiddle with the way you perceive stuff. Okay, so let's make this a little bit more, let's head towards the world of investments. What you can see on your screens now are two states of mind. Okay, winning, losing, gains, losses, green and red. And you'll see that those two states of mind are separated by a blue dot in the middle. Right now, from a stock trading perspective, that is the price that you paid for the stock. Now, what happens when the price goes up? You move into the green zone or the win zone, right? When the price goes down, you move into the loss zone or the red zone. You'll notice that the red block is bigger than the green block, about 2.5 times bigger, because you will experience about 2.5 times the dissatisfaction when the price goes down by £100 than you will satisfaction when the price goes up. You don't feel the same way. It creates two separate states or two sets of emotional biases, right? In the green zone, we become regret averse, right? So we're worried or we fear that the position is going to reverse, right? So the winning position is going to turn into a losing one. In the red zone, we become loss averse, right? So because losses are so painful, we don't want to hit the trigger or pull the trigger on the trade so that we actually realize that loss. So these two different states of mind create a behavior tax, right? We end up not trading enough in the green zone. Okay, so we actually miss out on the gains, and we end up not trading enough in the red zone. We let the losses run, and we end up trading too much in the green zone, right? Which means we miss out on future gains. And the combination of these two things is called the disposition effect, right? Two emotional biases. In global literature, about 1.3 to 1.4 times, right? Which means that there's 1.4 trades in the green zone for every trade in the red zone in general. Now, for the technically minded of you out there, if you don't worry too much about the lines in those two diagrams just indicate a change in preferences. Okay, in the red zone, the line is steep, which just indicates a loss aversion, right? So way more sensitivity to losses, which means that, again, we're not pulling the trigger in the loss zone. So let's quickly just go through how we calculate the disposition effect, right? What we're pretty much doing is looking at the probability distribution on either side of that blue dot, right? So we're checking to see how likely people are to trade on either side. So let's assume we have MMH shares, and MMH shares start off at $15 in January, and a trader buys 100 of them. In March, share price drops a little bit to $13 a share, a trader buys another 100. In April, price is now 16 Rand a share. Trader decides to get out of the position or sell out of the position. Now, the minute there's a trade on the Momentum Securities platform, that pretty much goes under the microscope, right? So we have a look at what the trader sold versus what they could have sold. And in this example, we see that the trader was also holding ABSA shares. And for the ABSA shares, we see that the average buy price was 160 Rand, current share price is 150 Rand. In other words, that position is in a paper loss position, right? Now, in this example, the trader converted 100% of their paper gains into real gains with MMH and converted 0% of their paper losses into real losses. Green zone, red zone, right? And that indicates to us basically that there's a disposition effect at play because the trader is more likely to trade in the green zone than the red zone. So that's just quickly how we calculate it. If we move over to the results, so we can see that a large study we conducted on the Momentum Securities platform, 10,000 clients, about 9 billion Rand in trades, 2016 to 2021. The overall disposition effect on the platform is very similar to international standards, 1.39 times. Surprise, surprise, in COVID, there's a mountain. Right, so COVID kind of just amplifies our emotional biases once again. So what's happening in COVID? The disposition effect increases to 1.9 times. Okay, now I'm just going to go over briefly again what this means. So remember, green and red zone. If it's 1.39 or 1.4, there are 1.4 trades in the green zone for every trade in the red zone. That means 1.4 out of 2.4 trades, or 58% of trades are happening green zone, right? When it escalates during COVID, 1.9 trades for every one trade in the red zone. That means 1.9 out of 2.9 trades in the red zone. That is 66%, right? And of course, the reverse means that only 34% of trades are happening in the red zone. Okay. So remember, the culmination of this, the behavior tax here, is that we are not trading. We're not trading enough in the green. We're not trading enough rather in the losing zone, and we're trading too much in the winning zone, right? So we're missing out on gains, and we're also letting our losses run too much, and that really is the kind of major effect of the behavior tax here. Now, this gets very interesting when we start contrasting this with behavior in unit trusts on the Momentum Wealth platform in unit trusts, right? So if we look at exactly the same time period. So 2016 to 2021. Okay, we see the mountain again there, right, during COVID. So this is investor behavior on the Momentum Wealth platform. And obviously there's no trading happening here, but people are still engaging with their portfolios by switching, right? So what we can see here is that in 2020, every switch transaction on the Momentum Wealth platform on average wiped out 6.5% of that client's portfolio value, okay? 6.5% per switch on average. In 2021, that subsided a little bit to 3.5%. I can tell you that those levels are well above what happened in GFC or global financial crisis in 2008. And what we can also see, that line is on the way up again. So, again, with the introduction of the war in Ukraine, higher inflation prices, the behavior tax has elevated once again with market volatility. But I think what's important here, if we contrast this to the disposition effect study, is that engagement in portfolios in unit trusts was up by 50% during COVID, right? That's record levels. Engagement in retirement income option or living annuities was up by 100% during COVID, right? So that's in retirement savings now in living annuities. So just think about this for a second. We've got two groups of people, right? We have execution-only traders who are becoming extremely loss-averse during COVID, right? So the disposition effect is basically telling you people are loss averse, right? They're very scared to trade in that red zone. So we have execution-only traders who are taking their hands off the steering wheel during COVID, and we have advisors who are advising clients in unit trusts and living annuities who are increasing their engagement during COVID, right? So one group is taking their hands off the steering wheel, the other group is actually becoming more engaged. And I think there's some very interesting differences between those two groups of people, particularly when we look at the context of the decision. But it certainly appears that the behavior tax is directly related to the advisor's disposition as well. And I think that's something that we can debate at the end as well. But this is very, very interesting in terms of just the surface level results. So the question now is, what do we do with all this stuff? So I've showed you two pieces of research. How can we help advisors and clients to make better decisions? And the answer really lies in segmentation, right? So I'm going to unpack the securities results a little bit more because they're very interesting. Things get even more interesting when you start slicing and dicing the data. So what you can see now on your screens is different groups of people on the horizontal axis by age. And what you can see on the vertical axis is the first row is going to tell you the proportion of the population that group makes up. The second row is going to tell you the assets under management of that population group. And then right down at the bottom is going to show you the disposition effect during COVID, before COVID and during COVID. Okay? Now, I'm going to draw your attention to the Gen X's, right? So Gen X's make up 28% of the Momentum Securities platform. They also hold about 28% of the assets under management. During COVID, or before COVID, their disposition effect was 1.92 times, so really way elevated above the levels that we'd expect from international norms. During COVID, their disposition effect increased to a whopping 3.92 times, right? And what that basically means is those traders were 80% of their trades, in fact, more than 80% of their trades were taking place in the green zone, less than 20% of their trades were taking place in the red zone, okay? So what do we do with that information? There's plenty of information, or plenty of research out there to show that a very, very good way to limit the disposition effect is through stop losses. Now, what happens with a stop loss, if you think about it, you're setting a rule before you get into an emotional state about what your minimum is, right? So at 90%, I'm out, I'm done, that's my rule, right? And once you enforce, or once you put that rule in place, and you actually act on it, because that's an important piece as well, right? You have to pull the trigger. It means that we can actually increase the engagement in the loss zone, research shows, by 100% or more, okay, with a stop loss. But what we also do in the green zone is, by using a stop loss, we buy psychological insurance, right? So even if our position does reverse, we now have a floor on the losses that we can take. And we see that actually trading increases by just under 50% in the green zone when using stop losses as a trading strategy. All right, so these are some of the things that we can do again to communicate through segmentation to start addressing this element, or this idea of a behavior tax. Now, what we can do in the world of unit trusts, or what we have done in the world of unit trusts, there is we use some machine learning algorithms basically to help us unpack a lot of switching data, right? So from 2006 until 2021, and what we basically do is we train the algorithm to look for similarities in risk and return preferences, right? So the algorithm basically here is going to look at clients who are doing the same stuff at the same time. And we found 4 statistically significant patterns of behavior on the Momentum Wealth platform in unit trusts, okay? And the first one we call the avoider, right? So avoiders are risk averse. They don't like risk. They generally stay away from it. And when they do invest, they tend to get stuck in conservative assets, okay? I think we all have clients like that, right? People who just kind of stay away from risk, and they want to stay in that cash plus space. They have the lowest behavior tax, or lowest value eroded from switching, but they also pay a different kind of behavior tax, right? So we know that staying in safe assets for a long period of time is not a particularly smart investment strategy, okay? Next, we have the market timer. There was a market timer at the back. Next, we have the market timer who's prone to herding, right? So the market timer is greedy when other people are greedy, and fearful when other people are fearful. And you can see there's a very clear pattern of people who do the same stuff as other people do, right? Those are the market timers. They switch to the same things as what other people do. Anxious investors are loss averse, right? There's a very big difference between loss aversion and risk aversion, right? So the anxious investors don't mind taking risk, very happy to take risk. At the first sign of market volatility, though, they move into cash and cash plus strategies, okay? And then finally, we have the assertive investors, the overconfident ones, right? So those are probably your worst, again, your nightmare clients. They're also the least likely to take advice from financial advisors. Also very, very happy to look at the next big investment trend or deal, right? Remember, like cryptocurrency, they say, how do you know someone's invested in cryptocurrency? They tell you. It's like, how do you know someone studied at Oxford? They tell you. Cryptocurrency, not so much anymore, though. Huh? So what we can see here, and the very interesting thing about this study was that we didn't ask the algorithm to look for behavior tax, but it naturally split the population into different groups that were destroying different value at very different periods of time. Right, so again, it's a segmentation story as well. Can we start engaging with people proactively, giving them the right message at the right time to the right person, right? As we end off this story today, I'm going to sort of circle back to where I started. So about 6 months after we opened our specialty coffee shop, we decided to close the doors, right, in October 2020. Now, I can tell you as a behavioral scientist, I am not immune to emotional biases, right? So my wife and I battled with loss aversion, right? I mean, we poured a substantial amount of our savings into this venture, right? We battled with regret aversion. So what happens if we close the doors and someone else goes and opens a spot in the same place and they make a massive success out of it? So these are the kind of things that we battled with. We battled with the sunk cost effect, right? When your decisions about the future start becoming more about the past. And by the way, this works in relationships as well, right? If you speak to a psychologist, as well about relationship advice, the sunk cost effect affects us in relationships as well. When you start thinking more about the time you've invested as opposed to the future prospects, you have a problem. So it's very difficult. Having knowledge of this kind of stuff does not make anyone immune to it, right? Because when you get tired or sucked up into that situation, it makes life very difficult. So my father-in-law was a professor of neurolinguistics at UNISA for 20 years. Neurolinguistics is a fascinating field. It's like the science of search engines, right? So when Google says, "Did you mean?" there's a lot of science that goes kind of into the back end of that. And he also studied psychology. And he helped us process the failure correctly. Okay, when I say process the failure correctly, it's important that failure is a bad teacher or can be a bad teacher because it hides risk. Okay, so there's stuff that we can control, and that's the stuff we can learn from, right? So the mistakes that we could control, we were in control of, is the stuff we learn from, but we also need to put stuff at the door, right? Could not have predicted a global pandemic, right? That's kind of stuff you have to leave at the door. We can't take responsibility for that. So he really helped us process this failure correctly, and that I can tell you is worth something, because the loss aversion, I mean, we nearly made a decision to open up another shop to try and make up for the one we had, to change the line of business into a full-blown restaurant so we could take advantage of deliveries. Who could we borrow from? Those discussions saved us hundreds of thousands of rand, right? So that is worth something. So I want to go back to the 3 key lessons. Emotional biases can cause a behavior tax, right? And financial services providers have a duty, I think, and a responsibility in the future to help financial advisors diagnose this kind of stuff correctly, right? The second thing is, the second lesson that we talked about was investment advice is about way more than just numbers, right? So on your tables, I see a few of those infographics floating around. Advisors are starting to collect new skills, counseling, right? Financial therapy, psychology. Psychology is now 8% of the CFP syllabus, right? And the reason is that there can be so much value added in helping people process their financial struggles. And the last thing is that perspective matters, right? So I'll never forget something my father-in-law said to me. So what we did was we took all the equipment that we had and we made a little coffee bar at home. Right, so I've got a lovely espresso machine sitting on the bar with a lovely grinder, and there's really, really nice cappuccinos every morning in the house, right? And he said to me, he came up to me one day and he's like, "Paul, you always buy like 2-3 cups of coffee a day, right?" And I was like, "Yeah." And he's like, "Well, the first cup of coffee you made cost you $700,000 here." And I was like, that makes me feel great. Thanks very much. And he's like, but hang on a second, the second cup of coffee will cost you 350,000. And the third one will cost you 233,333 rand, right? So eventually, this whole process will have cost you nothing, and all you'll be left with are the experiences. So again, perspective matters. Thank you very much for your time.
So our next speaker is Ashish Swarup from Aikya Investment Management, which he co-founded in 2020. Aikya is an independent, employee-owned investment management company that specializes in managing emerging markets, equity portfolios. And investing in emerging markets is the topic of Ashish's presentation today. Fundamental to Aikya's approach are the concepts of stewardship, resilience, and sustainability. These are words that are familiar to us all, but I believe Aikya's interpretation of these concepts are unparalleled in the investment industry, and I'm excited Ashish has joined us today to discuss them in more detail, along with the investment case for investing in emerging market equities. So over to you, Ashish.
We started this firm 2 years back, but our team has been investing in these markets for almost, 3 decades. So I'm here to share our experiences, so please feel free to stop me anytime, and I'm sure you're from an emerging market yourself, so you'll find a lot of things quite relatable. I think the first thing, just a few slides to outline why emerging markets are interesting places from an investing perspective. So this chart you've probably seen already. It just essentially outlines the convergence of stories. So a lot of these countries, basically, if you go back, let's say 500 years back, they were just all similar GDP per capita level. Then Western European countries and America sort of, pulled ahead in terms of prosperity level, while a lot of these countries just fallen behind. But now for last 20, 25 years, they're converging. Obviously, it's not a done deal. Not everybody is converging, but at least the major countries like China, India, Brazil, Indonesia are on a real convergence trend. On top of it, you also have a very favorable demographics. So, Japan, you can see it is a basket case almost, but even the other Western countries like UK and US are much worse in terms of demographics versus some of these emerging countries. And then so you have these sort of very rosy predictions. This is just one of the predictions where, for let's say in 2030, out of top 10 majority of these countries will be, from this universe. Of course, not 100% of this is going to be correct. You can see some countries like Russia here, which may not actually turn out to be true. But the broad point is that the big countries like China, India, Indonesia will actually be there and will be important enough not to ignore. This is all very just the summary of the positive case. And this, I'm sure you've sort of read about it and heard about it in a lot of marketing presentations. But the problem, obviously, this is that this doesn't translate into actual investment returns. There could be a lot of economic growth, but when we talk about actual returns, then the returns are actually not very good for the last 5, 10, 15 years in these markets. And one of the issues here is we think it's is significant amount of corruption. So the lack of rule of law, lack of good institutions, and here just this chart just shows you the number of people, share of people who have bribed versus the corruption perception index, and the countries on the left are actually most of the emerging markets. On the right, the developed countries. What it leads really is just a few points. A problem of investing in these countries, which is, coming again from South Africa, you're very familiar with, political cronyism, weak institutions, and sort of deteriorating in general the rule of law, and again, dominance of state-owned enterprise, which makes things quite difficult. What it actually then translated to, sorry to go jump, but this is basically so if you go back any time of the year, the MSCI emerging market returns have been extremely sort of mediocre. So even last 20 years, it just barely matched MSCI World benchmark returns, or actually S&P has done better than that. So you can actually ask, then, so how do you match these two points where, long term you have a very good sort of economic prospects, and the growth is much higher than a developed world, but it doesn't really translate into investment returns. So what I think, in our view, these are the reasons. So what you have is a situation where there's a lot of GDP being added, but there's very little wealth being created in these countries. And we think the reason is really these reasons, where you have more and more state capture, or more and more what you call corruption, and so on. So there's scope for private entrepreneurs to create wealth and share it with minority shareholders is obviously is challenged. So what we think, there are certain rules you can follow in these markets, because the economic growth is real, and you can actually benefit from that if you follow, in our view, a disciplined investment approach. The first rule in our view is downside protection. So because these markets are quite volatile, and could actually have a significant drawdown. So first rule is really to protect the downside. And there's just a simple sort of maths here, where it shows that if you have a portfolio which is less volatile, it actually compounds at a higher rate, because the geometric returns which investors experience, and not just the arithmetic returns. That's the first rule we follow. But then the second, the problem there is that, okay, you can protect downside, but ultimately what we're interested in is long-term compounding of returns. And that's when I think these points become extremely valuable. So you not just protect downside, but also you think about how the long-term compounding works. So that's the, again, few points we follow in our approach. And I'll take you through each one of these points and why these are important, and illustrated through a few examples. I think the most important thing here is to realize is that things about sustainability, or talk about stewardship, these are not nice concepts in emerging markets. They are actually must-have in any investment approach, because these can just break or make an investment case. So what really we are talking about here, what really we think about, how do we invest and what type of companies we're looking for. So if you think of any company, let's think of, let's say, ShopRite, for example. You can think about a company from 3 different lenses. You can think about how good are the financials of ShopRite, what's the balance sheet, earnings, cash flows may look like. You can think about how good is the franchise of ShopRite, who are the competitors, who are sort of the industry structure is, what you sort of, how the industry looks like. Or you can think about who are the key decision makers behind ShopRite, who are, Christopher Weiss, or who are sort of CEO, or whoever is the decision maker. And that's sort of, we think, in emerging markets, it's a lot more important to focus on who are the main decision makers, who are the, what you call, stewards behind the business, than the business itself. Business itself is actually important, but what is really important is who are the people running the business. And that's very emerging market specific concept, because in developed world, good quality businesses are usually run by good quality people. So let's say Apple is a good quality business run by good quality people. But in the emerging market, a lot of times, because of corruption, because of lack of rule of law, because of political cronyism, what you have a situation where the good quality businesses are not really good because they're genuinely good, but because they're good because they're run by political cronies, or they could be run by corrupt people who are better at bribing. And the problem in investing in those businesses is that if the winds or the political regime shifts, or if, let's say, the company you're investing in is run by president's son-in-law, and the president sort of, son-in-law loses favor with the president, then you start losing a lot of money very quickly. So what you think is the stewardship, which is analyzing and making sure that the quality of people behind the business is good, is really, really important. So this is essentially a longer sort of checklist which we sort of go through. And stewardship is not just about the people. So the first thing we try to test is that what is the purpose of a company? And that's, again, quite important in these markets where there is very little what you call long-term regulation or sort of checks on and balances against what governments can do. So if your business is not really relevant to what the country wants to achieve, then it's subject to all kinds of expropriation risk or regulation risk in the government. Think about, let's say, a casino. If you are running a casino which is not very helpful to the country, then it becomes a very easy cash cow for politicians to ask for bribes or ask for favors and whatnot. So we think we really test for that. So we really want a business which is actually contributing, because even for the worst type of politicians, they think twice before asking for money or asking for some sort of favors from business which are actually helping the people around them. Governance is second point, which is totally non-negotiable. So that's the easiest way to lose money in these markets. Basically, either backing a shareholder who's not very well aligned, or backing a shareholder who's corrupt and takes your money. So that's part of the reason why the benchmark, emerging market benchmark, does not do well, because it's sort of full of companies which are either state-owned companies where you're not aligned with the state owner, or they're full of businessmen who are corrupt. Environmental social stewardship, again, is the same reason as is the purpose. Basically, you're trying to answer the question that the people you're backing, are they cutting corners? We think if they're cutting corners either on environmental side or social side by not paying full taxes, not being responsible, then they might be cutting corners elsewhere. They might be cutting corners in their accounting practices, or dealing with you or with us as minorities. The culture, again, we spend quite a bit of time establishing that, trying to understand how is it a place to work, and is it a sort of winning culture? Because again, these markets are quite competitive. So you have multinationals, all kinds of companies competing against the companies we invest in, and trying to establish that whether this company can withstand a globally sort of competitive environment. The quality of franchise, like I said, is obviously important. But from our perspective, what we are really interested in is the business resilient. Again, it's very emerging market sort of focused approach, because these countries, again, you probably appreciate, are very, very cyclical. They are a lot more cyclical than a typical developed market. So what you need is a business to withstand bad times. And if a business is able to withstand bad times, then it sort of survives long term and does well long term. So that's what we are trying to establish through several means. We're trying to test how the business did during bad cycles, how is it run, and is the competitive advantage gets better over time or not. The quality of financials, valuation, again, I think are important. Valuation actually is really important, because we if you overpay, or if you try to, especially in these markets, then it just harm the long-term returns, and it just staying disciplined is quite important. So if you have an approach like this, and then you end up with a long list of companies you don't want to buy, and I'll illustrate that through a few examples just to make it a bit more because otherwise it could get a bit more abstract. But a few points here to highlight. I think the point around negative social utility is important, because if you invest in some of these companies like tobacco, defense, casinos, coal, are extremely prone to corruption, because they're just seen as politicians from easy way to make money, and they just use it that way. So as a minority, then you have huge amount of leakage, which you don't want to see. Things around misaligned management teams and poor governance is really rampant. So, and again, because of lack of rule of law, as minority, your rights are limited. So if I see something being wrong at, let's say, British BP or Shell, or any developed market company, I can write a letter to the board, and it might get worked on. But if I see something wrong with a Korean conglomerate and write a letter, I might be denied a visa next time to Korea. So it's really, your rights are really limited. So you have to be very careful whom you're trying to back. And then opaque and aggressive accounts. Accounting standards are not really uniformly good. So you have to really be very careful. And if anything is aggressive or creative, or you just sort of you should avoid. So I thought I'll take you through few case studies just to illustrate the points I'm trying to make. I think the first thing is around state-owned enterprises and why we sort of avoid them. From our perspective, it's just a classic case of principal agent problem where the people who are running these companies, they don't really worry about what shareholder feels like or what shareholder does long term, because they are bureaucrats. They are being paid a salary which doesn't go up and down. It's not linked to the performance of the company. So this is just an example. So these are two banks I thought were quite interesting comparison. So one is called Kotak Mahindra Bank on the left-hand side of the slide. It's a private sector bank in India, and it's run by the person whose name is Uday Kotak, whose name is on the board. Then the second bank is Punjab National Bank, which is like a state-owned bank. So in 2012, Punjab National Bank was almost 3 times the size of Kotak, in terms of market cap. It traded on 1 times book value, and let's say Kotak traded on like 3 times book value, because a much smaller bank in 2012. What really happened over the last 10 years is the Kotak book value compounded at 16%, while Punjab National Bank actually declined at 18% CAGR. Now, this is a valid question to ask that in a country like India, where the GDP growth is around 7 to 8% a year, how can a bank actually decline its book value at that rate? And given it's actually very good banking market, it's got really good sort of market structure. Now, the problem here again is it's a state-owned ownership, Punjab National Bank. So any sort of major banking scandal over the last 10 years, all the crooks from liquor baron Vijay Mallya to Gupta brothers from South Africa, they all borrowed from Punjab National Bank. And you can, it's easiest place to borrow because it's so corrupt. You give some money to the loan officers and you get the loans. And that's the reason the book value declined, 18% CAGR. Last 10 years has seen 5 different CEOs. And you can see the performance. So even though in 2012 you would have gotten the shares at 1 times book value, those shares actually have not made you any money, versus Kotak Mahindra Bank, where you paid 3 times book value in 2012, but they've actually made you a lot more money versus owning Punjab National Bank. And that's just, I've not really cherry-picked this example. If you compare the performance of any state-owned company in emerging market versus its private sector counterpart, it's a very similar comparison. If you pick Chinese state-owned banks or Russian or Brazilian resource companies and compare them against the private sector companies, that's the comparison you get. On the right-hand side, we just did this in general universe. So there's a significant performance gap versus the private family-owned businesses versus state-owned companies. And that's really we focus on. So our approach is to just think about only family-owned companies or owner-managed companies, because that's the easy way really to enhance the performance in this universe. But family ownership is not really enough. So you need to think about other factors. So like I said, the other main thing we look for is the purpose. And why is it so important is just, we thought, illustrated through this example where if the companies are not relevant, if they're not solving a problem for the country, they attract attention from politicians, and politicians tend to go after those companies. I mean, it could be explicit like this happened here, but it could also be implicit where they ask for bribes or favors. This is a case where Chinese education companies, where for a long time, these companies were seen as very high quality by a lot of investors. These are private tutoring businesses. So they offer private tutoring services online, offline, for anyone who can afford them, for just so that the kids can clear certain exams in China. When we thought about, okay, what's wrong with education? I mean, it obviously has a purpose, but when we thought about these companies, the answer was not very clear. Firstly, these are very expensive private tutoring services, which means most of the Chinese cannot afford them. And also, it sort of actually creates a gap between people who can afford them and who cannot. So it's increased the inequality in the country. When we actually also analyze these companies, it was very clear what they state as a purpose is very different to the actual purpose. So obviously, if you ask the management team, they'll say, oh, it's great. We're obviously solving the education problem in China. But when you actually see how they spend the money, you see they spend the money more and more on marketing, sales, and actually less and less on teacher salary or infrastructure in their classrooms. So it became very clear to us very quickly that these are just companies without a purpose, and we failed them on the quality test. For a long time, it was not a problem. But then there's another bigger picture issue here where China is quite bad in terms of fertility rates. It was designed like that for 20 years back when they restricted births per family. But now they want to solve the problem. They see it as a problem, so they want to increase the births per woman. But because the cost of parenting is so high, and partly driven by this, it is not easy. So suddenly you have a situation where the whole sector of companies are really working against the purpose of what the country wants, and that's really became an issue. And then, as you might know, 18 months back, Chinese government regulated against the whole sector. So a lot of times in these markets, just avoiding landmines like this becomes very, very important for preserving long-term returns. Alibaba is another example. Again, it's just seen as very high quality business for a really long time by a lot of investors. We actually wrote about it about, I think, 2.5, 3 years back, where we sort of laid it out that actually it is not the high quality that people think it is. So the first question we usually ask in these companies is that, is there an original sin? What was the original sort of the way the business was set up? Was it helped by politicians or helped by someone, questionable? So let's say in case of Colombia, Peru, a lot of, Latin American countries, a lot of the business families who seemed very clean today, if you go back 15, 20 years, they have dealings in drug or money laundering. So that becomes original sin. In Russia's case, as you might know, again, in 1995, a lot of the businesses got privatized under questionable circumstances, and that's an original sin in Russia. In India's case, a lot of the businesses who, again, appear very successful today, they have original sin because they got this critical, crucial license because of their political connection. That becomes an original sin. Now, what's wrong with original sin, you might ask, because if you have a political connection, why not exploit it? But the problem is that political connections are never stable, so they keep shifting. So if, let's say, you were a favorite of president and the president shifts, then becomes a problem. So we tend to avoid companies. So here at Alibaba, the original sin was that Alibaba was originally propped up, or at least had major shareholder, Shanghai faction of Communist Party, because that faction was in power for a while, from early 2000s to 2013 when Xi Jinping took over, and they got significant amount of favors. I mean, eBay against eBay. eBay was banned from launching payment service in China. A lot of favors. I mean, there's like a whole list of favors Alibaba got, and the way Alibaba had to pay it back was when Alibaba got IPO'd in 2014. They did a series of questionable M&A transactions to pay back to Shanghai factions. If you look at a lot of M&As they did, they were questionable, like buying a Beijing movie studio, for example, because the owners of that studio were people from that faction of the party. So that's basically, that's a quid pro quo. So if you've got favors, then you have to sort of pay it back through lots of leakage. In there, this is a VIE structure they have, and it's quite complex and is plenty of scope to leak the cash flow out. So this is basically what happened here. So when Xi Jinping came to power, he was against the Shanghai faction, and he started tightening screws on Alibaba. And last 3-4 years, we are seeing the impact of that. So Alibaba's franchise, which was 60-70% market share with total dominance on payments in China, got challenged against new rules, and the whole sort of the franchise quality deteriorated because ultimately the political affiliations actually shifted. So we avoid that, because then it just, as an investor sitting in London or in developed countries, we are the last ones to know when the political shifts or political affiliation shifts actually happen. Steinhoff, again, you're probably quite familiar with this story. So we we actually avoided that for a long time. And there are multiple sort of, I won't go into detail, just multiple red flags here, but one of the major red flags from our perspective was the tax rates, which Marcus Joost was sort of somehow managed to pay. So this is just actually from a Viceroy report where, every company he bought paid around 30% tax rate, which is not surprising given SA corporate tax rate is 28%. But Steinhoff tax rate was never more than 15%. And you try to ask him the question or try to spend like weeks analyzing how they manage it and look at their annual report, it was never 100% clear. So when things like these happen, we just sort of avoid, because we think, ask the question, if they're cutting corners towards certain stakeholders, in which case the government, where else are they cutting corners? And it was very clear then there's a lot of other questionable transactions around M&A, buying questionable assets, complex corporate structure. A lot of things then don't add up. So there's obviously there are a lot of negative examples, but then what do the type of companies we like or we invest in? This one example where it's a consumer company in India. And I just use one of the slides from their presentation where, since 1996, they compounded shareholder return at 24%. In Indian rupee terms, which in dollar terms turns out to be 18-19%, and the growth in earnings at the same rate, around 23%. And why is it so successful is because we think, so it's got a very clear purpose. So what they're trying to do is trying to help personal care in India in a very affordable way, and also they work through the supply chain. So they're very strong in terms of helping the suppliers, which again helps their competitive advantage and sort of very virtuous cycle. It's founder driven, and this is what we tend to like, where so what the question we ask is that if something happens to the company, who feels the pain? As a shareholder, if you obviously feel the pain, but is there someone in the company who's feeling the pain? The question, do they have the soul in the game? So the founder's entire net worth obviously depends on this company. But more than that, because his entire self-worth or his sense of self-worth, what he stands for, also depends on this company. And this is exactly the type of people we really like. They not only suffer financially if something goes wrong, but they also suffer emotionally if something goes wrong with this company. We also like a combination of founders and the professional management. So we like the combination where the founders or the owners sit on the board, they control the long-term capital allocation, while the professionals actually run the company. So because the professionals are usually much better in day-to-day operations than the owners, especially when the company is scaled up to a scale this company has. We like simple businesses, and we like usually companies that are just focusing one country. Again, going back to Steinhoff, one of the things which we didn't like is that operating in 20 different countries and so complex that it's very hard to understand what they actually do. And we like, generally large addressable market for just simple products selling to a lot of people. And I think the other point, which is generally underappreciated again, is resilience. So we really like the companies who have actually, proven their resilience through various bad times. So how they've done through bad times is one of the things we really look for. And if the companies has come out through a bad cycle with market share gains or with better competitive advantage, and this is basically what we really are looking for. Just to maybe stop there, just to very sum up, is really, I think the main point which I always try to emphasize to investors is that it's very clear. I mean, anybody who spends even 2 minutes looking at this, the emerging market economic opportunity is very clear, but it does not translate into investment success that easily. And because the emerging market benchmark is not a good quality benchmark, unlike S&P, which is actually full of good quality companies. And the reason behind that is lack of rule of law, corruption, cronyism, and all kinds of shady characters who run businesses in this universe. So you have to be extremely picky, extremely fussy in whom you choose to back. And if you actually do, back good quality people, good quality entrepreneurs, then the investment success comes with it. And I think the last point is the sustainability is not an optional point. In this not nice to have, it's actually must have. You need to ensure that there is a purpose, is very well governed, and they are actually taking care of all stakeholders. Thank you very much for your patience.
Some institutions are born for greatness. Places like Groote Schuur, where many great innovations have happened and still do, because they've created an environment where people work together. It was here that on the 3rd of December 1967, Christian Needling-Barnard transplanted the heart of accident victim Denise Darwell into the chest of Louis Washkansky.
We did not realize at that stage that the first transplant of the heart would make such tremendous news. The only time that I realized that I was doing something different, and this was really the moment of truth, is when I looked down into the chest of that patient and there was no heart.
After studying at UCT, Chris put together the team that eventually performed the revolutionary operation.
And when the blood came back into that transplant heart, immediately it showed life. And eventually when I shocked it, it started beating. Everybody started talking and everybody was It was very emotional.
At the time, it seemed revolutionary, but in time, it would become the norm. Momentum is a place where people work together, in partnership with advisors, to create innovations that make a difference in people's lives. Just like Chris and the team, we at Momentum are purpose-driven, as we believe people don't invest for the sake of investing. People live for their dreams and aspirations, and all that matters is to achieve their unique goals. Just as the team at Groote Schuur were there for Chris Barnard, we at Momentum Investments are here for you. We believe in the partnership between you, your financial advisor, and ourselves, and together we will strive to make your dreams a reality. We follow a philosophy that puts the heart back into investments, and together we create the unstoppable force of momentum.
Think Tank is an event designed exclusively for investment professionals and institutional investors. It is a true collaboration of investment specialists providing independent, non-conflicted views and opinions, achieved by avoiding sponsorship and other financial promotions, and with the aim of sharing knowledge and ideas, giving Think Tank an excellent reputation within the investment industry. Originally designed to provide our South African clients with a global, independent perspective on investment matters, Think Tank has gone from strength to strength, and delegates now attend from all over the world, making Think Tank a truly global event. The combination of independent thinking, thought leadership, idea generation, and depth of analysis supports delegates in their quest to achieve their own clients' goals. The first conference was held in 2002 in the heart of the City of London, the world's leading financial centre, and has been held there for the last 20 years, with the exceptions of 2007, when we chose New York, and 2010, when we ventured to Hong Kong. In pandemic-ravaged 2020, we held our first virtual conference, which was a huge success with over 1,000 delegates online. Think Tank aims to cover topical events in the global economy and financial markets, with a particular theme each year based around the most important issues facing investors, as well as exploring longer-term perspectives on investment opportunities globally. Each year, we invite a range of outstanding and experienced speakers from around the world, including strategists, economists, investment managers and analysts from global investment banks and specialist asset management firms. We carefully select the topic for each speaker to make sure we offer an unrivaled variety and depth of analysis and strategic thinking. Book your seat for Think Tank in the heart of the City of London.
Good morning, everyone, and a very warm welcome to Think Tank 2022. We're proud to have built and maintained such a strong following and reputation for this conference over the years, demonstrated by some clients having attended almost every one. We look forward to celebrating these milestones with you this evening at the very special dinner venue of St Paul's Cathedral.
This is a truly remarkable time. I mean, we have gone through one crisis after another. Trying to pin down forecasts and an outlook is incredibly difficult.
And there's great opportunity right now. And I'll say for growth stocks in particular, Europe is cheap. It's actually has some really good ones that are pretty attractively valued.
It's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio.
Portfolios that we are building for the next 10 years will probably have to be very different from the way we built portfolios over the last 40 years.
I guess I'd sum up my highlights in three key things. Firstly, just the quality and the breadth of the speakers over the course of the last couple of days. Some of the new thinking and new ideas that came from those presentations.
I think one of the highlights was just to mingle again with fellows from abroad and also to get insights from outside South Africa in terms of world economy, what we can expect going forward, and also the challenges that we see in Europe as well as the US in the future.
Definitely hearing from advisors all over the world about the challenges facing their clients.
You have to be extremely picky, extremely fussy in whom you choose to back, and if you actually do, back good quality people, good quality entrepreneurs, then the investment success comes with it.
I must say, away from the conference, our function at St Paul's last night was amazing, but then the content generally was pretty good, and I really learned a lot and have so much to take back to my investors.
And Paul's Cathedral tour was super special. Having dinner in an ancient building and experiencing an atmosphere was definitely a highlight, and I will remember that for quite some time.
Think Tank is an event designed exclusively for investment professionals and institutional investors. It is a true collaboration of investment specialists providing independent, non-conflicted views and opinions, achieved by avoiding sponsorship and other financial promotions, and with the aim of sharing knowledge and ideas, giving Think Tank an excellent reputation within the investment industry. Originally designed to provide our South African clients with a global, independent perspective on investment matters, Think Tank has gone from strength to strength, and delegates now attend from all over the world, making Think Tank a truly global event. The combination of independent thinking, thought leadership, idea generation, and depth of analysis supports delegates in their quest to achieve their own clients' goals. The first conference was held in 2002 in the heart of the City of London, the world's leading financial centre, and has been held there for the last 20 years, with the exceptions of 2007, when we chose New York, and 2010, when we ventured to Hong Kong. In pandemic-ravaged 2020, we held our first virtual conference, which was a huge success with over 1,000 delegates online. think tank aims to cover topical events in the global economy and financial markets. We carefully select the topic for each speaker to make sure we offer an unrivaled variety and depth of analysis and strategic thinking. Book your seat for Think Tank in the heart of the City of London.
As multi-asset investors, we seek to capture value wherever that may be. However, as we do not have special skills in every asset class ourselves, our value add is to select the teams that we feel do offer that alpha generating opportunity in the space concerned. Tim Creed is head of Schroders Private Equity Investments, which is a significant team of over 150 employees. That strength and depth of resource is crucial, and I'm delighted that Tim is here to explain in more detail what they bring to our investors. Over to you, Tim.
So the presentation topic is about what really is venture capital and growth capital, and how can you make sustainable returns. So it's quite a broad topic. So I've got a few different sections to this presentation. The first part will be to introduce Schroders Capital, just a couple of slides. Then there's going to be a chunk about what is venture capital, what is growth capital, which seems a rather obvious thing to talk about, but I've noticed over my time that if you get 10 people in a room, you might get 15 or 20 different definitions. So I think it's worthwhile spending a few moments on that. And then I've got a couple more sections where we go into some of the challenges today, and then how we see we see the market and what we believe that investors should focus upon. So starting with Schroders Capital, so this is really a repeat of what was just mentioned. So Schroders Capital private equity is about 15 billion. We cover the full private equity landscape. We have about 150 people, and I'm one of the 4 global investment committee members and in charge of the private equity investments. No story on private equity would be complete or would even start properly without something about performance. So we have to have this, or we choose to have this at the beginning. This is the slide that we call our everything in one slide. And as much as I love private equity, it's fair to say that people within private equity are quite good at making their performance look really good. So therefore, what we want to do is just say this is everything. And so this is everything we've done, the good, the bad, the ugly, venture, growth, buyout, realized, so sold companies, as well as unrealized existing companies. And what we do is we put all investments in the calendar year of when we made the investment, and then we say what is the IRR of those investments. So choosing one at random, 2013, you can see it's just above 22% net IRR to us. And I kind of chose that one because the aggregate of everything is 23% net IRR, which I think you'd say would compare favorably to public markets. And really that comes out by the fact that over this whole time we have about an 8% outperformance. So the other way to look at private equity is using what's called a multiple. So this is the cash on cash multiple. And normally people would just use the numbers on the right-hand side, but we do like to be a bit more transparent about everything we've done. So what this slide shows is our direct investments and co-investments. And here I'll say another word. As a platform, we invest in direct investments and co-investments, and this is where we invest directly into a company. We also invest into secondary transactions, where the most common one at the moment is something called single asset GP-led deals. And this is where we carve a company out of one fund and put it into another fund as a single asset. And then the third thing we do is we invest into funds themselves. So if you think of a famous venture capital fund in the US, in Europe, and Asia, the groups like an Accel, Sequoia, Charles River, etc., we are fund investors in most of those groups. And the reason we do that is because that provides the investment opportunities for our single asset GP-leds and also for our co-investments. But this slide is purely the direct investments and co-investments. And here you can see on the left-hand side, we've completed 200, just over 200. We have 50 that have been realized, and realized is the word for fully sold. And so the other way that people within private equity talk about their performance is they say their realized gross results. And for us, it's 28% and 2.9x. So if I was to say, if you think about our performance, if you just say 2.9x, then that's a good place to start. And a nice topic about fees, because of course you have to make sure that private equity has fees and you're very transparent about the fees. Now let's move into private equity and what is private equity. So we've got a couple of slides on this section. And the first one is really to set the big picture and to really emphasize about what makes it different from public markets. And you see here that there's 4 things that are mentioned. The first is really rather obvious, it's not listed. But I really want to focus on the other 3. Private equity is active management, and it's active in 2 main ways. The first is we choose the companies we want to invest in. If you compare this to public markets, for example, in the UK, there's a few hundreds of companies that are public. If you compare that to private, there are millions of private companies in the UK. If you extend this out to Europe and you extend this out to the US and also to Asia, there are tens of millions and hundreds of millions of companies that we can choose from. So the active ownership is really, it starts with selection. We have a very big pool of companies to choose from. The second part of active ownership is that we really work with our companies. Either we work directly with the companies to help change them, or we work with our private equity managers that we co-invest with to help change and improve those companies. That active change, active improvement, whether it's through add-on acquisition, whether it's through expansion to a new geography, whether it's new products, whether it's helping management or enhancing management, whether it's strategy, is really vital. And I would always argue that that element, the selection of being able to choose between any companies, plus the active ownership of changing companies, are really the main differentiator between the private markets and public markets. There is, though, 2 extra points that I think are worth mentioning. The third is aligned. Through the whole private equity landscape, we have, we believe, a greater alignment of interest from the end investor through to the private equity manager, through to the management team, through to the employees of a company. And that normally manifests itself in equity ownership. Most of us will only get significant payouts if the equity value of those companies significantly increases over a prolonged period of time, and we sell the company at a significantly higher price than when we invested. The final area is illiquid. It's clear private equity and venture capital is illiquid. Most vehicles are 10 years long. Most investments are 3 to 5 to 7 years. There are nuances, there are differences. There are 5-year vehicles, there are 15-year vehicles, and then there are also investment trusts that are, of course, evergreen vehicles. But one thing that should be noticed or noted, that even in the shorter duration vehicles or even in the evergreen vehicles, there's a long-term mindset. So the individual investments are always very illiquid. It's not possible to buy into a private company and then sell out the private company in a short period of time. So this is a slide which sometimes gets passed over, but I do want to spend a few moments on. This slide really shows the 4 main segments of the private equity world: venture, growth, buyout, turnaround. Now within venture, I'm going to emphasize 2 main parts. The first part is seed stage, early stage, which is Series A, Series B rounds. The second part of venture is the late stage, the Series E, Series F pre-IPO rounds. Now, the way we look at the world, and the way that we've looked at the world for the last 25 years, is that first part, the seed stage, early stage, is a very attractive place to invest and has been an attractive place to invest for many, many years. The late stage is very pro-cyclical. The pre-IPO stage has great moments, but it also has terrible moments. And if you look at the history of venture, there have been 2 periods where late stage has been hit with a huge boost and then a huge crash. The first was the classic dot-com boom and bubble, boom, and then the crash of the bubble. And the second is actually what's going on right now with late stage, where it's had a very good run for the last few years, but is in the middle of a crash. They're the 2 segments within venture I'll say a few words about. The second area is growth. I was in a meeting earlier, and someone asked me, what's the difference between late stage and growth? And the way I would describe it is that venture has clear financing rounds of Series A, B, C, D, E, where different investors come in. Growth, however, is a growing company. In almost all cases, it's profitable or near profitable, and it will only have 1 round of financing. Sometimes 2, but really it's 1 round of financing, and it's into a profitable company to make it grow further. And that's the difference between venture and growth. The growth companies really are already sizable, more profitable companies. The third segment is buyout. This is small buyout, mid buyout, large buyout, mega buyout. Small and mid is the bulk of the industry by numbers. The large buyout and mega buyout is what you read in the newspapers with take private of Asda or Sainsbury's, etc. or the more recent one that's been in the news about Boots. And the final area is turnaround, which is really fixing a company. Now, across this spectrum, across those 4 categories plus the subcategories I mentioned, our strong belief is there's 2 areas that investors should avoid. Unfortunately, they are the 2 areas that get probably 90% of all media attention. And those 2 areas are late-stage venture and large mega buyout. And for our strong belief is they are the 2 pro-cyclical areas. We believe that gets 90% of media attention. It also gets a lot of investor attention. But the reality is, for the people within private equity, those 2 segments are actually not very important. Those 2 segments account for about 5% of deals. So the other 95% of deals were the other segments I mentioned. It should be noted, though, that they do also account for probably 30+% of the capital invested. So there's good logic why it's in the media. However, what we would always like to say to people is that you should really focus on all the other segments I mentioned. So the seed and early stage venture, the small and mid-stage buyout, and then turnaround, because those segments are 70% of the capital, 95% of the deals, and they're the areas that consistently outperform rather than go through boom and bust. This is a slide about venture. So although I've just said about late-stage venture and pre-IPO, there's a reason why it's always in the news, and that's because of the unicorns and decacorns. A unicorn is a venture capital-backed company that's worth more than $1 billion. A decacorn is a venture capital-backed company that's worth more than $10 billion. So far, the number actually went a bit above $1 billion, above 1,000. There are over 1,000 unicorns out there. So this is not companies like Google or Facebook that were unicorns at one point and then IPO'd, but are now public companies. These are companies that are still in the private world. We, within Schroders Capital, are investors in about 135 of the unicorns, and we're in 80% of the largest decacorns, so 8 of the top 10 companies. The key, however, for all these investments that we've been in, but also our strong recommendation to investors, is you must get in the seed or early stage. If you join one of these companies in the late stage or the pre-IPO, you are then going to be affected by the boom and bubble that I just mentioned before. This is another way to talk about some of our exits over the last couple of years. Here it just mentions the top 10 liquidity events. So a liquidity event is basically the cash-on-cash return that we've received. Interestingly, we had an IPO last year of Airbnb. That's not on this list because we actually didn't get much cash back, because that was a company that we invested in at kind of the mid-stage rather than early stage. So all these, the reason we got 60 times, 30 times, 40 times is because we were in there right at the earlier stages. I'm just conscious of time, so this is another way of showing some of the logos. Again, venture capital often has logos, so these are many of the other companies that we've invested in. Now let's go into challenges, because challenges is clearly something that happens right now. We are in a clear challenging market. Everyone's seen what's happened over the last couple of years. I don't need to rehash the world news, but there are challenges. So what I'll do is I'll focus specifically about the venture and growth segment. And this slide has 3 different sections. The first section is what we call our fundraising indicator. This is basically a different way of presenting the normal slide that shows fundraising per segment. The reason we do it like this is on the left-hand side, it shows venture capital fundraising with an 80% confidence interval. So you expect venture capital fundraising to increase year on year. That's generally a good thing because there's more companies being created globally. What you don't want to see, though, is far too much money in the segment. And what you see back in 2000, the red line went way out above the 80%, and hence there was too much money. You also see what's happened in the last 2 years. There's been far too much money going into venture capital. And that's been driven primarily by hedge funds and asset managers who focus on public equity who are trying to go a bit earlier. The middle chart shows the effect of that on the number of unicorn creation. You can see that huge explosion because when you have too much money, it looks for companies to invest in. And so the slide earlier had 1,000 unicorns. I'd like to emphasize or highlight that that's probably too many. And you can see why there. On the right-hand side, you see the amount of capital that's gone into companies from a different perspective. So this slide, on the right-hand side, we look at the average growth in funding round of 3 different stages. So Series A, seed, Series B to E, and Series F onwards. So over time, over the last 5 years, it's every 5 years, the fundraising rounds do increase a bit. And so to see an increase of twofold over 5 years is about the long-term trend. And so this last 5 years for seed and Series A, it's been similar. What you see though on the right-hand side is the Series F round, sometimes also called the pre-IPO round. Those companies are now 10 times more expensive than they were 5 years ago. Now, a lot of people have claimed in the last couple of years that's because we're at some form of quantum shift and it's different dynamics and blockchain is changing the world, medical devices are changing the world, etc. And some of that can be true. There has been a lot of innovation in this last 5 years. However, it cannot take account for or cannot justify a tenfold increase in our view. This is a slide that shows a different story, but kind of a similar message. This looks at slightly more established companies and looks at companies that are the SaaS companies. And you see here the correction that has happened over the last couple of years, where you see that the NASDAQ is traded down and also SaaS, that's software as a service valuations, have also traded down significantly. So, what about the opportunities? Because that was a bit doomy gloomy, wasn't it? This is a slide that just talks about some of our exits and our emphasis on early stage. I'll actually skip this because I think this slide here is more important. What this slide shows is our view of the differences between early stage and late stage, and we split it between these 4 characteristics. If you look at valuations, our strong belief, and this is built upon not just the last 5 years, but we've been investing in venture capital now for more than 25 years, is that even with the dot-com boom and the big boom of the last couple of years, venture capital has consistently had steady valuations in early stage. And to give this in a bit more examples, we are investing in funds as well as companies, I mentioned. So if you look at Google, there was only 2 venture funds that backed Google. We were in one of them. So our investment in 1998 led to a huge IPO in 2004. We were super happy about that. There's further stories about Google as to whether we really should have sold everything in 2004, considering the way Google has gone. But the story behind it is still that there's a great company that was founded in 98. If you got in at the seed stage, early stage, then you made a great return. The late stage, as I say, is highlighted there. Competition, for us, competition for venture capital series, early stage and seed stage, there's a core group of venture capital managers who have proven themselves through cycles. I've mentioned a few names, the Sequoias, the Accels, the Charles Rivers, Redpoints, etc. If you look at those venture funds, they are all highly access restricted. You can't get into index even if you wanted to. Index close funds within minutes, effectively, and they choose the investors that they want. Fortunately, we've been invested with them for many, many years and in many of their funds. The benefit of that is that when they have a co-investment and they need a co-investor, they go to their long-term investors. But it does mean that to do venture capital, you have to be in venture capital for many, many years. It's not a segment you can dip into and dip out of. And I think that's one of the big challenges of the last couple of years. There's a number of investors who try to dip into venture capital as it's become more exciting. The bottom topic is about burn rates. A lot of people say that with larger companies that have raised these large funding rounds, it's okay because they can change their burn rates. They can simply recruit fewer people, or they can maybe even fire a few people, but they can carry on growing. That's possible when you're a small startup and you have 20, 30, 50 people. It's a lot harder when you're a late-stage investment and you have 1,000 or 5,000 people. The ability to change your cost base at that level is really, really hard. Some of you may be aware of the firm Sequoia. They did in fact, actually, Tim might speak about Sequoia later on because he knows them well. They produced a letter not too long ago that basically told all of their investee companies to control their cost base. And they did that some months ago in preparation for what's going on now. So all companies across the venture spectrum, from venture to seed stage to late stage, are paying far more attention to their cost base. The key is that earlier stage companies have more flexibility. So one of the questions that comes up is now a good time to invest? Our strong belief is that you must invest in venture throughout. And one of the justifications for that is because good companies are created constantly. And so clearly we've chosen very good companies for this example, as you'd expect, but I think the message really is there. And that is, if you look at the companies that were founded, the top part is just before the 99, 2000, 2001 boom and bubble and bust. And what you see is if you look at the companies that were founded just before that, Google, PayPal, Salesforce, those companies, they were founded, they grew a bit, they then faced a horrible recession, and yet they came out of it super strong. So market-changing, game-changing companies can be founded before a recession and still plow their way through it. Same with companies that are founded just after the recession. Facebook was founded in 2006, and yet it carried on growing. It came out of the problems of the dot-com crash didn't affect what effectively at that time was a dot-com company. Clearly nowadays Facebook is a very, very different company, but that innovation that was required in 2006, 7, 8, 9 really came from its earlier years. So what we see is companies can be founded throughout. If you look at the bottom half, that's looking at the more recent GFC, the global financial crisis. You see the companies on the left, like Airbnb, but also the companies on the right, Moderna, Uber, and Stripe. These were founded afterwards and have really, really significantly grown. So our strong belief is you must stay in venture yourself because all there are good companies that are created throughout cycles. Within the world of venture, we look at a number of different segments. These are not the only 6 segments that we follow or that we target, but these are 6 of the segments that we think are particularly important where game-changing companies can happen. And I keep referencing this game-changing phraseology. The reason for that is because venture capital is not an incremental business. There are companies that make great returns, the 5x, 10x, 50x, and there are write-offs. You need to have those game-changing companies that can deliver 10x in order to compensate for the ones who don't make it. So you really got to think big and go for high-quality companies. There's 3 characteristics that many of these logos, and I should say these logos are all in our portfolio, 3 characteristics that I'd say pretty much all of them have. And I don't wish to summarize our venture capital into 3 sentences because our global venture team get crazy with me when I do. But the 3 things we really look at is we've got to have a great idea. So it's got to be a great company. It's got to have a really good proposition. Secondly, it's got to have a really great management team. It is the management team of these companies who drive their growth. And so the quality of management teams is essential. And the third is it's got to have great co-investors, great venture investors who are backing that company because they will be there through the different cycles as and when needed, and they can really help the companies grow. So as long as a company has those 3 things, then it's likely that we're going to invest as long as it also fits part of our long-term themes. A couple of slides on the SUPP, the investment trust. So I presume most of you know a bit about the investment trust. It's a UK-based investment trust. It has historically had a focus on UK companies. In the last few months, we've actually extended the strategy to make it global. And the reason for doing that is because we found a number of great UK companies, but really in order to maximize the total returns, considering our platform is a global platform, and we have offices in the US, we have offices in Asia, we've been investing in Silicon Valley and the US since the 90s, we've been investing in China, we've had a Beijing, Shanghai office since 2000. We strongly believe that you should have a global outlook, and so we've recently extended the strategy to be global so that we can then target the best possible venture-backed companies globally rather than just in the UK. But you see some of the key points on the right-hand side which kind of reinforce or sit with the 3 things that I summarized earlier. This is the 3 parts of our core strategy. So within venture, it's the seed and early stage. We really look for companies that can grow, and hence the phrase early stage, and then a bit further down the 4th bullet point about ability to rapidly scale towards growth. For us, growth is really key. The second segment is growth companies. These are companies that are near profitable or are already profitable, but are really proven, sizable businesses. We were keen to put these into the trust because these really de-risk the trust. Considering the history of the trust and where the trust has been through, we wanted to have a lot of high-quality companies in the trust. So therefore, we want to have a balance of both the venture and the growth companies. They are, I should say, they are growth companies that in many cases we've also backed earlier. And the final area is life sciences. I've kind of skimmed over life sciences, but we do have a global life sciences practice. So if you think of many of the famous healthcare-backed companies of the last 20 years, we're also in many of those. It's interesting, when most people think of venture, they think purely of IT, and certainly Google's and Facebook's warrant that, but it's been interesting to see how many genuinely game-changing companies are venture capital backed. And so we do ensure that we cover venture, we cover biotech. One of the biggest challenges here, though, is you need to do a lot more reserving. They generally need to have multiple fundraisings, and so you need to reserve a lot more capital for this strategy, which suggests that it might be a bit more capital intensive. There's certain ways to ensure that it's not capital intensive, but the key is that you You don't get caught in a financing round when the company needs a financing round and you don't have the capital or the market is not open. So we make sure we keep a bit more capital back for these life sciences business to make sure that we can cover through the full cycle. I think at that point, yes, that's good. At that point, I'll open it up to questions to see if anyone's got any questions about venture capital, about what we see as the opportunities and also the risks. Tim is the founder and CEO of one of our portfolio companies. I think it's best that I let him really describe what he does and how he does. But I think the thing I'd really want to emphasize is Tim and his company represent the three things that I mentioned as vital characteristics. It is to have a great company, so a great product, great positioning, market differentiation. Secondly, it's to have a great management team. Without great management, you don't get anywhere. And thirdly, it's that they've got great investors. And for us, that's really the holy trinity of a successful venture investment. So with that, I hand it over to Tim.
It's great to be here with you all. Thanks for having me along. So what I'm going to do is I'm just going to give you the kind of soup to nuts overview of Tessian, who we are as a company, how we got started, what we do, and some of the dynamics around our business. What I want to try and do is bring just a glimpse of what it is to start a startup and grow it. We are a Series C stage company. A bit of background on myself. I'm an engineer by training. I studied here in London and then started working at HSBC at the beginning of my career in investment banking. I co-founded Tessian in 2013 with two friends from university. We were all working in investment banks at the time, and that's where we saw the problem that we are now solving with Tessian. I just got back from 2.5 years living in the US. I picked a great time to move 3 weeks before COVID hit. So that was an interesting experience, but a lot of our team now is based in the US. We've raised over $120 million from world-leading venture funds like Sequoia, Excel, Boulderton, Local Globe, and very importantly, Schroders. And what is amazing about the Schroders connection is that actually really Schroders are one of the first companies to let us through their doors to pitch them about using our product and our technology. So Schroders are an incredibly early adopter and very visionary in how they think about using new technology to secure their organization. So that's actually how we got to know Schroders. And then later on, Schroders came to invest in our Series C. So here we are. This is the genesis of our company. So this is our first office, way before work from home was a thing, but this was our office and this is our apartment. This is where we lived. This is a very candid shot. We did not take it thinking that one day we'd be up on stage showing it to people in irony. But I think it just really captures how embryonic, raw, no frills the genesis of a company is. It was 3 of us. We were 23. We had one idea for a company, and we got to work. We started building the software, and the cheapest way that we could actually get that done was by moving into an apartment and living together. And then since then, we've now built Tessian into what it is today. So we start our journey with email. Email is the main artery of communication for every enterprise. Still true today, even though we have instant messaging and other platforms. Email is still the main artery. But email is also an enterprise's biggest security risk. And that's because people control email and people are fallible. People break the rules, people make mistakes, and people can be hacked. In fact, when we read about stories talking about ransomware, talking about hacks on organizations, what many people don't realize is actually the origin of that attack is usually through somebody's inbox and somebody opening an email and that email impersonating a trusted third party like Microsoft or your boss or the CEO of a company getting you to do something. So email is a major, major threat vector for organizations. And email security today is crowded with point solutions And the legacy platforms in this space are not stopping today's threats. So what we did at Tessian, our idea was, okay, we'll have a look at what's in market today. Who are the main players, and what do these companies do? And the approach that the sort of old generation of security took was a signature-based approach. So that would mean you basically codify the patterns of threat that you are looking for with a set of rules. And then you check a condition to say, if the threat looks like this, then we'll say it's a threat. Otherwise, sorry, if the email looks like exhibits any of these patterns, we'll say it's a threat. Otherwise, we'll let the email come through to the organization or be sent. And we said, well, rather than do that, we're going to build a set of machine learning algorithms which actually learn the difference between normal and anomalous email behavior. And that's what we've done at Tessian, and that is what we do today. So we are building a human layer security platform to automatically secure people using email. We've expanded our product over time, but we do a number of things. So we do inbound email security, that is checking every incoming email automatically, verifying that it is from the person who they say it's from, it is safe to open, and it's safe to be released to the organization. We also sell a number of products that deal with outbound data loss. So it's unbelievable, but the #1 data breach under GDPR in the UK is misdirecting an email. So that's one of the things we check for. Are you sending an email to the wrong person inadvertently? And we use machine learning methods to detect those abnormalities. And we also can use machine learning to detect when data is being exfiltrated through email. It's still one of the main ways people get very sensitive data out of an organization is just by emailing it to their own personal domain. And every week we stop thousands of data breaches for our customers. This is the amazing thing. For me, this is the most rewarding part of starting a company. Way back when I said to myself that I wanted to become an engineer when I was older, I thought the best thing in the world would be creating a technology that didn't exist before and actually seeing it have impact on the world. And every single week, we are preventing thousands of data breaches for our customers automatically using these algorithms that we have designed. The way we do this, really simply, we are deployed to an organization and we learn from a historical set of email data. So every one of your organizations has email data that lives within it. We tap into that and we essentially use that data to train our machine learning models. And then when an email is being received or sent, we do real-time analysis. That's where the very complicated part of our technology is. How do you do a check on 100 million data points in 300 milliseconds? But we found ways to do that. We then, if we think an anomaly is present, we show a notification to the employee in real time, stop the email from being received or sent. And then, of course, we provide all this data to the security team as well, so they have visibility on these threats, what's getting through, what's being stopped. As Tim mentioned, one of the most important things about building a technology company is actually not the technology, but the team behind the technology. And I'm really proud that over the past 2 years, we've built a really stellar executive team. These are people who've worked at very large organizations, many from the security industry as well. And we also have a great board of investors and non-execs who act as advisors for us. You have to remember with Tessian, we were 23 when we started the company. So people ask me what I did before starting Tessian, and it was basically nothing. This is my first job. So it's really, really important to have those people around you. The second most important thing when building a technology company is your customers. And it's amazing to be here today because actually our first 2 geographies, the US and the UK, that's where our majority of our customers are. But the third geography is South Africa. And we actually have a lot of customers in South Africa. We work with most of the major banks, most of the major asset managers in South Africa as well. So we have over 400 world-leading organizations using our technology every single day. We secure the New York Stock Exchange. We secure ARM, the chip manufacturer or chip designer. And we also secure Evercore. And my favorite quote is Chris Turek's quote. Chris is the CIO of Evercore and said that Tessian is one of the top 3 products he's bought in his career. And it's the only piece of security software where he actually received thank you notes from his employees. By design, we have built Tessian to be a cloud-native platform. What that means is we deploy our software and it connects to a cloud backend that is fully scalable, and we can update and add to that over time. And what we've done over time is add these extra modules into our platform. So we've expanded its capability, and that means that we can drive upsell of our product through our customers over time. So we sell subscription licenses, so it's annual recurring revenue, and we expand that revenue over time. So it's a very, very good, very, very powerful business model to have, like many other SaaS companies. And this is an enormous market that we're in. So email security is a $4 billion market going to a $7 billion market. And you just see some of the highlights here in terms of our growth and accolades. We were named the fastest growing enterprise software company in the UK by the Sunday Times in 2020, which was a great accolade. But I wanted to spend just a few moments of talking about actually what's next. So with every great company, you start off doing one thing and then your ambition scales and you start to think about how your initial feature set can become a platform. So everything I've spoken to you about today is actually part of something much, much bigger. We think of this as a new paradigm of how we secure enterprises today and a new paradigm of cybersecurity. Cybersecurity really through the years has evolved from networks and firewalls to endpoint security and securing the devices that we use. But actually today, 90% of data breaches are being caused by people. We've kind of secured what we think of as the machine layer of the organization, and actually now we are saying that our entire security strategy as global enterprises is going to be reliant on a human being doing the right thing 100% of the time. And that sounds like a bad idea. In fact, many of you here probably have phishing simulations that your security team asks you to do. We are trying to train people to filter phishing emails. We did not train people to filter spam emails. We invented technology that took that problem away. And that's exactly what we think we need to do now. We are building what we think of as the third pillar of security for the enterprise. We call this human layer security. So this is not securing the network, not securing the devices, but securing the people within the enterprise. I'm going to skip over some of these slides, but I just wanted to give you a taste of a recent piece of product development that we did, and that is around the human layer risk hub. So for the first time ever, we've been able to provide insight into the security strengths and weaknesses of individuals within the enterprise. And this is about promoting a better security culture. Many people will say that people, how can I politely say this? We sometimes talk to people who are very frustrated that their employees clicked a link or did something that was seemingly idiotic. I absolutely don't believe in that, right? We have to look to the user interface of the technology we have first, right? If somebody clicked a link in an email, they clicked it because you're meant to open links in emails. So what we wanted to do is actually showcase where the security strengths and weaknesses are of individuals within the enterprise. So actually security teams can make more informed decisions about how to go and train and coach those people over time and also deploy technology to secure them. So this is what we did. This is a screenshot of that product that is now live for our customers. We provide this risk breakdown by employee, by department, and then over time you can see how risk scores trend for individuals. So this is that first step towards a human layer security vision for the enterprise. And actually this market, sorry, some of the fonts are a little overlapped here, but this market is a $26 billion market. It is a monumental opportunity for the company that can take this, and it's growing faster than the two previous largest categories in security combined. So with that, I want to say thanks.
Good afternoon, everyone. My name is Emma Clift, and I'm the Head of Distribution Services at MGM. We hope that you're enjoying the conference so far. I was fortunate to join the in-person event a number of weeks ago, but it's great to be able to watch the presentations again. I think each time you hear a presentation, you're able to pick up something slightly different. Paul Nixon's session, incorporating behavioural finance, really made me think about how we position our solutions and how we as investment managers can help you as advisors with your clients. Speaking to some of the delegates after the event, they really applauded the work of Alvarium, managing to tackle the slightly uncomfortable challenge of homelessness in the UK in a very sensitive way, but then also being able to provide stable returns for their investors. Tessian's presentation is also memorable, really bringing to life how Schroders' early-stage venture capital investment is boosting disruptive, innovative businesses and helping to create world-class companies. To wrap up, just a reminder that the virtual platform will remain open until the end of October, if you'd still like to view any of the presentations again. SA and UK delegates will still be able to get CPD points during this time. After October, all of the videos will be available on our events page and the Global Matters portal on momentum.co.za, as well as on the Global Matters WhatsApp bot and our MGym website, momentum.co.uk. Thank you again for your attendance today, and we really hope you're able to join us tomorrow for day 3 of our virtual Think Tank Conference 2022.
Good morning, everyone, and a very warm welcome to Think Tank 2022. We're proud to have built and maintained such a strong following and reputation for this conference over the years, demonstrated by some clients having attended almost every one. We look forward to celebrating these milestones with you this evening at the very special dinner venue of St Paul's Cathedral.
This is a truly remarkable time. I mean, we have gone through one crisis after another. Trying to pin down forecasts and an outlook is incredibly difficult.
And there's great opportunity right now. And I'll say for growth stocks in particular, Europe is cheap. It's actually has some really good ones that are pretty attractively valued.
It's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio.
Portfolios that we are building for the next 10 years will probably have to be very different from the way we built portfolios over the last 40 years.
I guess I'd sum up my highlights in 3 key things. Firstly, just the quality and the breadth of the speakers over the course of the last couple of days. Some of the new thinking and new ideas that came from those presentations.
I think one of the highlights was just to mingle again with fellows from abroad and also to get insights from outside South Africa in terms of world economy, what we can expect going forward, and also the challenges that we see in Europe as well as the US in the future.
Definitely hearing from advisors all over the world about the challenges facing their clients.
You have to be extremely picky, extremely fussy in whom you choose to back, and if you actually do, back good quality people, good quality entrepreneurs, then the investment success comes with it.
I must say, away from the conference, our function at St Paul's last night was amazing, but then the content generally was pretty good, and I really learned a lot and have so much to take back to my investors.
And Paul's Cathedral tour was super special. Having dinner in an ancient building and experiencing an atmosphere was definitely a highlight, and I will remember that for quite some time.